Good evening and a very warm welcome to First Issues. Depending on what plan they have signed up for, a consumer may find themselves having to pay thousands of pula in excess when trying to claim from their motor vehicle insurance. A frustrating misunderstanding at an emotionally and financially trying time. One of many examples where consumers are just not fully aware of what they are really paying for on a monthly or annual basis. These types of misunderstandings have led to a steady mistrust of insurance offerings meant to actually benefit the consumer when used correctly. Tonight we continue to dissect this broad topic with members of our distinguished panel from last week, with Dziki Nganunu, former CEO of Botswana Insurance, focusing on short-term insurance in the first segment of our program, and Lulu Rasebotse, CEO of Liberty Life, concentrating on long-term insurance. We trust that this evening's conversations will be instructive for most of us. Welcome back to the program as we expand upon the topic of insurance from last week, this time differentiating between short and long-term insurance. Our experienced guests thoroughly dissected the topic as a whole, and financial advisor Edna Dambe now explains to us the difference between short-term and long-term insurance.
Yes, there are two distinctions. In insurance, you've got long-term and you've got short-term. And with long-term, you're basically looking at life and pensions. And short-term, you're basically looking at, property, things of that nature. But clear distinctions are either long-term and short-term or life and non-life. And that's the best way to appreciate these two.
Former CEO of Botswana Insurance, Dziki Nganunu, is back and expands upon this definition, giving us the various types of insurance that can be identified as being short-term.
Non-life or short-term insurance really is about insuring property, assets, either of an individual or of a business. The individual is typically called personal lines insurance, and for businesses typically it's called commercial or corporate insurance. For individuals, the most common policy here in Botswana is the motor car insurance policy. That's what most people take in Botswana. Of course, you also get your house insurance, and there are various types of house insurance. It depends if you own a house or you're renting a house. There's different types of cover. You can be covering the building or the contents. You can also cover your personal effects that you take out of the house, like your laptop and cell phone. So there are different policies around that. In addition, there are personal accident policies under your personal section. These are policies that would cover you if, for example, you're in a combi and the combi has an accident, you get injured. It will cover you for that. On the business side, there's a whole range of policies, too many to mention this evening, but a huge number of policies, starting with your workman's compensation, which is a basic and basically mandatory policy for anyone who's employing people to protect workers. And then there's a whole lot of other policies relating to the building, to the vehicles the business might own, to any liabilities they might face. And liability insurance is a whole new area in itself. There's all sorts of liability cover available to companies, liability from being sued for someone tripping on your premises, if by accident you set fire to someone's building. There are all sorts of policies around liability. And every year, more liability policies become available around the world, including in Botswana. For example, the most popular, the fastest growing policy at the moment is the cyber risk policy. Again, this is really applicable for companies and not so much for the individual.
Insurance products, as we have been told, are not an issue of one size fits all. But which of these products does our guest consider to be necessary for most consumers?
From an individual perspective, you have to look at what assets you have. And if you have an asset of high, which you consider to be of particularly high value, something you cannot afford to lose, that's something you should consider insuring. If there's something of very relatively minor value, you do not really need to insure it because you can replace it quite easily. But when it comes to something like a vehicle, obviously your house, if you have a lot of furniture in the house, those are the type of things you want to insure. One of the common problems we find with motor vehicles is there are a lot of people who are not insured because it's expensive, and they don't realize that there's actually a cheaper form of car insurance, which is the third-party insurance. And the third-party insurance protects you against being sued by someone else. So if you're driving a car and you're uninsured and you bump into someone else, you got to be careful because you might bump into a car, an expensive Mercedes worth $500,000 or $1 million. Never mind that your car you bought for $30,000. How are you going to pay the $1 million? Because you will be taken to court. And every year, insurance companies take lots of uninsured motorists to court for causing damage to insured vehicles. We don't hear about it a lot, but it's happening every day. And people are losing out because of that. The third-party motor vehicle insurance is quite cost-effective, so that's one of the basic ones. Anyone who owns a car should have that. The comprehensive policy, which covers even the damage to your own car, is more expensive, and maybe that's what you take as a second step. But I would certainly advise everyone who owns a car to have at least third-party insurance.
Which products does Diki consider to be underutilized by Botswana?
Yes, I think house owners insurance is quite uncommon. There are a lot of people who own property, and the cost of insuring is actually quite low. It's actually very cost-effective insurance. Now, most people probably don't take it because they think the house won't burn, but you know, it covers a lot more, not just the burning of the house. And this is why it's important to speak to an intermediary to understand what actually is covered by a house owner's policy. What benefits are there? There are lots of benefits which people are not aware of. For example, if you have domestic workers, your house owner's policy actually covers those workers for injury at work. Most people don't know that. And it's actually, by law, you are required to cover any workers, as I indicated earlier, workmen's compensation. In the house owner's policy, it's actually included. Most people don't know. Most people don't know if a geyser bursts, might be included in their policy. There are lots of things that are included even under your motor policy that people are not aware of. Some motor policies include cover that allows you to hire a car for a week or so while your car is being repaired. Many people don't know and don't claim because of that. It's important always to read your policy wording.
Could there possibly be some benefits to short-term insurance products that most consumers simply aren't aware of?
For the personal consumer, again, most policies include a liability component. So under your house owners, for example, there's a liability cover. Liability is not well understood in Botswana, but basically you can be taken to court by anyone for anything that might happen as a result of your negligence. You know, someone came onto your property and the roof fell on their head. You know, that's liable. You can be sued for that. We see this more commonly in shops. Someone trips because the floor was being polished. Someone trips, they get injured, they sue the company, or they write a lawyer's letter. And typically, but even in your own home, there are those type of risks. And same thing with motor vehicles. The liability section, which is the third party I just mentioned, is very important because unbeknown to you, someone might borrow your car and they end up having an accident and you're liable. You may not even have let them take the car. And again, the consumer must look at the wording to understand, you know, what is covered. All insurance policies, they're not all the same. Different insurance companies have different terms and conditions, so you cannot generalize. you have to look at the specific conditions of each and every policy. But typically your motor insurance policy, for example, will have a liability limit of 2.5 million. Generally in Botswana, that's the case. No matter what you insured your car for, you will be covered for liability up to 2.5 million. It's important that, again, you look at the specific policy wording that you have. Some policies have higher excesses, some have lower excesses. You need to understand what your excess is before you accept the premium, before you accept the quote. Some have multiple excesses, so there might be one excess for one particular type of accident. For a different event like a theft, the excess could be higher. You need to understand the different excesses. You need to understand who's allowed to drive your vehicle and who's not supposed to drive your vehicle. So in some cases, an unauthorized driver will not be covered. In some cases, they might be covered. Obviously, driving your vehicle, you must comply with all laws. If you break the law, for example, speeding, strictly speaking, your insurance company could reject the claim. So it's quite important for consumers to really read the wording in detail once in their lives. You don't have to read it every year, you just have to read it once and you'll be okay.
What does he mean by excess? It is a commonly used term in these circles that not all of us really understand.
In the insurance, short-term insurance space, typically there is an excess that is applied whenever a claim is paid out. So the insurance company will pay you the amount that you've insured it for, your asset for, less your co-payment, if you like, your contribution. And that's called an excess. And the excess varies. Some policies would not even have an excess, but most policies will have an excess. And the excess is typically a percentage of the claim. It could be 5% of the claim. Sometimes it's 7.5%, 10%. It can vary. And the fact that you've got a particular excess this year doesn't mean it'll be the same next year. The insurance company might change, and you must be notified about those changes. What you find is that often, in terms of motor insurance, your vehicle, after an accident, is taken to a panel beater. The insurance company will then pay the panel beater, but you have to pay the panel beater the excess before he'll release your vehicle. And that's sometimes where people get stuck, because they don't have the money to pay the excess, and the vehicle remains at the panel beater longer than they would have liked.
When we return, Lulu Rasebotse tells us the ins and outs of long-term insurance. Welcome back to the program. As in this second segment, we focus our attention on long-term insurance with the help of an industry leader. Lulu Rasebotse begins by detailing what types of insurance can be classified as being long-term.
Long-term insurance is what is also referred to as life insurance. Just by having said life, we know what that means. You are born, and the one thing that's inevitable besides tax is that you're going to die. So really, life insurance is coined around those eventualities which are going to affect your personal being. Being something like a death, which would be covered through funerals and other benefits. Being a disability, which could arise through a car accident or any other form of event, which could be you getting a critical illness, which of course would also impact your life. So these covers you find are in different channels or segments. I'll start with something like a bank assurance. Bank assurance is insurance which is driven through a bank, and that is something that really secures something like your mortgage or something like your vehicle loan or a personal loan, which then says in the event that you die or in the event that something happens such that you're unable to honor your monthly payments, the insurer will kick in and settle that amount. So that's typically what happens through bank assurance. Then you have corporate schemes, which in Botswana are commonly done through the employer. So the employer would say, as a value proposition to its employees, in the event that my staff member dies, we'll pay the family 4 times their annual salary. In the event that you get disabled, we'll continue to pay your salary, perhaps at a reduced rate, or we'll give you a lump sum because we realize that this disability necessarily suggests that you're unable to perform your duties. Also, through the employer value proposition, there are funeral schemes, which then says, if my employee dies, we'll pay the family. If my employee loses a spouse, we'll pay. Or if my employee loses a child, because obviously that has got financial implications. And in so doing, especially around funeral, it's really about our societal norms. Now, an employer does not want to be inundated with requests for advances, because obviously death is unplanned for. But now your employee is distressed, and you want to relieve that financial burden. And so the employer takes up such a policy. Beyond that, in this market as well, we are well used to what is called individual life, which is now you as an individual in your own individual capacity buying cover. This cover will also be for things like death, funeral, or disability. Now, oftentimes you find that in the market, especially in a market like Botswana, it's very common that people take out life cover, for example, for the purposes of their beneficiaries in the event that they pass on. But now as life evolves, you want to secure a mortgage. Now what happens is, oftentimes individuals will take that life cover and cede it over to a bank. Now that suggests that this life cover is going to be used to clear your mortgage in the event you die. But does clearing that mortgage now mean your beneficiaries have got finances at the tips of their fingers? No. So it's almost sometimes where you're using maybe the wrong solution for the wrong problem. Because in all honesty, you must try and separate the two. You want your beneficiaries to continue living in the comfort of that home you built for them, but equally so, they need cash so that they can further enjoy life, go to school, buy uniform, so on and so forth.
What should consumers consider when looking at long-term insurance options?
You must look at your personal needs. You must look at risks which come to your fingertips almost naturally. I'll take myself as an example. Before I had children, I had no need for life insurance, especially since at the time my parents were in active employment to a point where maybe to some extent I could actually ask them for money vis-a-vis the other way around. But the minute I had a child, my need for insurance came naturally, because now I have this person here who's solely dependent on me. So I think really it's about looking at your personal circumstances and, like the other speakers have spoken before, seeking advice through your intermediaries or directly through an insurance company, because underwriters are there to serve consumer needs.
How does one even begin to determine which insurance products they need? We asked our guests whether it's a case of simply imagining the worst case scenario.
Not necessarily every worst case scenario, because like I say, life in itself is a tricky business. Imagine you are in your bedroom, you happen to have a chandelier hanging over your bed. That chandelier may just fall and drop on your head, and that's it. But you never thought that was a possibility. But I think the nature of life is that every day you wake up, you're at risk of something happening to you. That is just the reality. But if you're going to overanalyze and look at every possible eventuality, you may find yourself in a bit of a predicament. But life generally, there's only two ways out of this. You come in and you're only going to exit via death.
Although our experts have shown us that insurance needs vary from case to case, is there a long-term solution that every consumer should have?
I would say everybody who has people who depend on them financially does need a policy which is going to kick in if they are unable to provide that financial security. Insurance is about compensating you, but not over-enriching you beyond what it is you were actually worthy to receive financially. So if it's somebody like myself or Lulu or whoever, and I'm living on 5,000 a month, the idea is not for me to take out insurance, which is suddenly going to make me live off 25,000. Because now that's being overcompensated. It's not compensation. It's getting enrichment through an insurance policy. An insurance policy must take you back to the original position.
We conclude our extensive look into insurance by asking all our contributors the point at which someone should look into getting any form of insurance.
From a short-term perspective, a business has to look for insurance the day it opens its doors. It needs workman's compensation insurance from day one, and then as soon as they start, they'll have assets, whether it's computers, whether it's motor vehicles, it's buildings. So from day one, a business needs insurance. An individual, in a way, it's similar. As soon as an individual starts working and starts to acquire assets of meaningful value, then again, they need to start thinking about insurance.
The minute you realize that somebody depends on you, you need to have some form of life insurance.
People need to understand that, yes, insurance covers risks. Not all risks are insurable. Do you understand? I mean, I can insure the risk of losing my expensive suit to theft, but not to wear and tear. Do you understand? So when I sit down and think of that which I need to insure, I need to also understand my ability to pay the premium. Do you understand? Because every policy has the premium you must pay. Every policy has the exclusion that Ziggy spoke about. One area which I find people do not understand is the exclusions in policies. You know, both short and long term. You find a person will take out a funeral cover for a third party and not appreciate that in the event of this third party committing suicide within a given period, that person is not covered because they were stated as a member. Are you with me? As opposed to a dependent. So we need to understand what is covered and what is not covered. But most importantly, even in insurance, understand that you are going to have to prioritize. So look at your needs, look at your budget, and understand which risks are likely to set you back most in your financial situation. And these are the ones that you need to at least put as your most priority.
It has been a very informative week, and next week will most likely be equally so. From me, Nametso Semakula, the team behind First Issues, and our sponsors, First National Bank, we wish you a good night and pleasant viewing.